Welcome to Investors Insights. Our topic today is Fed's market green light. We chose that topic because this Wednesday, the Fed has a very important meeting, and it also happens to be St. Patty's Day. But we're going to be watching a different type of green here at Five Plan Partners because on Wednesday, what's being said by the Fed chairman will be very important in relation to the markets. I'm joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Adam Van Zant. And we've just had a great meeting on portfolio strategies, and we're going to cover some insight about what the Fed may say or what challenges and obstacles they face as we move forward and start to end the first quarter of 2021. Bobby, I want to start off with you because I thought you gave a great summary about the topics that the Fed needs to address and how it could impact our clients' portfolios.
Yeah, Greg, like you said, the market moving event this week could be on Wednesday where the Federal Reserve will be in the spotlight. And while this week's policy decision will be more than likely yield no immediate policy changes, it will, however, take on additional weight in providing commentary on the central bank's thinking around the pace of the economic recovery and whether a faster than expected rebound might warrant a nearer term adjustment to the Fed's policy. But here's why the Fed's meeting this week is important. The market is expecting the Fed to keep rates where they are for some time, so even for another 2 years. So any hint of a change to their thinking on Wednesday could cause a big market reaction, and our highly leveraged economy might be ill prepared to deal with a quick rise in borrowing cost, which could hurt the market sentiment. So Chairman Powell has a tough but very important job on Wednesday of offering a more optimistic assessment of the economy while also addressing the fears of runaway inflation and trying to prevent the destabilizing rise in bond yields. So, because we continue to see growth in sectors like technology come under pressure because of the rates spiking higher. So, we'll be watching the Fed's press conference carefully on Wednesday to see what is said about higher inflation and also what impact the Fed will have on interest rates going forward the next couple weeks or month.
You're making great points there, Bobby. I think we also ought to emphasize to our viewers that the Fed can make these comments depending on how the market interprets them, can cause volatility in the market, but eventually things will adjust accordingly based on what the Fed is giving indications on. So the next few weeks, we may see more volatility, but at the same time, we still feel very positive about the economic growth that's taking place and also what's happening in the technology area, that technology is here to stay and we're going to continue in our lives, in our careers, see technology continue to move us forward as an economy. Now, Trey, you talked about the importance of interest rates, in terms of housing to the consumer. Give some more insight on that with everyone now knowing how important Wednesday is.
Yeah. So, the Fed, we often talk about how the Federal Reserve and interest rates impact corporate America, but as most of our viewers know well, that the interest rates impact every individual person largely through their mortgage. And so we've seen over the last year mortgage rates drop precipitously to a low of 2.67%. The 30-year Fannie Mae or Freddie Mac mortgage rate in December was the low of last year. They've started to creep back up. Now, it's not concerning. Currently, in March, the average mortgage rate is 3.05%. That's still much lower than it was this time last year, where the average rate was 3.5. But it's starting to creep up, and the Fed buys $40 billion worth of mortgages a month. So that pushes prices up and keeps interest rates down as long as the Fed is buying that many mortgages. Also, however, the mortgages, not just getting a new mortgage where it helps people, a lot of people refinanced last year. Individuals in America took $153 billion out of their homes by refinancing last year. That's a 42% jump in 2019. That increased the savings rate, and that really buoyed consumer spending last year during a pandemic. A lot of people still have those excess savings, so that can be spent this year. But that one-time refinance boom may be trickling out if we start seeing current year rates higher than previous year rates. We still have a good buffer between that of current year rates, again at 3.05%, last year at 3.5%. So there's still room for refinancing, but it's something we're looking at with clients, and when we're looking at their plans, does it make sense to refinance at these low rates? It often does, and you can either take money out of your house, or you can just reduce your monthly mortgage rate or mortgage expense and use your monthly savings for future savings and expenses. So mortgage goes into a lot of the American consumer, and something we're watching closely. Still a huge benefit, but the Fed is a huge driver of mortgage rates. And so that's something on Wednesday we'll be watching, not just for current market environment, but down the road mortgage market and how that may impact the consumer.
Well, and let me say this, Trey, I totally agree with you. You're talking to someone here that used to have a mortgage over 10%. And when I first got in this industry, there were mortgages out there at 15, 16, 17%. So to see interest rates this low and for home buyers to have this opportunity to refinance, to take advantage or to buy that new home is outstanding. And yes, interest rates always do cause concern, and also inflation is a possibility, is a concern. But these are still some really positive times in relation to what we've been through as a country. We have the vaccine out there now, and Americans are receiving that. Yes, there's the debate on the interest rates, but the market's showing a lot of strength off of this confidence level that we're starting to see come back into our economic markets. Adam, talk to us about hitting new highs. Talk to us about the numbers that our clients need to be following from a technical indication based on the fact of what Bobby and Trey were saying and what the Fed's going to be talking about on Wednesday.
Yeah, I appreciate it, Greg. And like you said, Friday's S&P close came in at a record high of 3,943. That pushes our new resistance level to 3,980 with a new support level of 3,900. One of the indicators we really want to focus in on is the 50-day moving average. We're continuing to see week by week that we stay above that. The 50-day moving average is currently at 3,845. So going back to Bobby's point and Trey's point, and not to hammer it too much, but the Fed speaking on Wednesday will be a big thing to look at from a consumer level, and it's something that could potentially, cause more volatility in the markets.
It could, and so we're going to be watching that closely. But again, hopefully our viewers are hearing that we see a lot of positive information out there, indicators taking place. So depending on what the Fed does, we hope during the day the Fed will give us great indications with their comments. And then that evening we can celebrate St. Patty's Day, and we will receive a green light, a market green light from the Fed. There's no guarantees, but we're going to watch it. We're going to navigate through it. It's hard to believe that this time a year ago, we were talking to you about our market strategies as COVID hit this country. We've navigated through that. We've continued to keep you informed. We're going to continue to do it just like this vlog. We hope you share it with colleagues, neighbors, friends, and family. And also continue to follow us on social media, Facebook, Twitter, and LinkedIn. We hope you have a great week. Wednesday is a pivotal time. We'll be watching it closely, and we're going to keep you informed. Thanks.